Free Use Living House channels for educational purposes only is not intended as financial advice. Macro Monday, and things are really zooming on the macro side for metals, not so much for crypto. We'll see if any of that swings our way this year. Many people do not think so. I think there is a potential eventually, but looking at ETF flows, it's pretty clear. A lot of money coming out of crypto. Most of this is Bitcoin and ETH, to be clear. 1.7 or so billion was Bitcoin and ETH, and then some altcoins, but globally not seeing a lot of love on the crypto side. And much like the ETH ETF flows chart in isolation, we really haven't seen some sustained big weeks. We've seen a few weeks here and there, but nothing crazy. And if we just contrast that with gold, even gold, honestly, you'd think the flows would be way higher than they are relative to what price is seen. I'd be interested on what the silver flows look like, but I don't think the gold positioning is crowded, and I don't think the silver positioning is crowded here either. And flows don't look crowded either. Flows last time, things topped were pretty significant, at least on the retail side. So this is likely institutional or central bank buyers and not necessarily retail, even though obviously retail is buying hand over fist any way they can. On a relative basis, it doesn't really look like it. This is the 30-day change over the past 2 years, and it's still significantly positive for gold. For BTC, to contrast, we are basically flat. We had some significant inflows. A lot of this could have been in-kind ETF related, and there was certainly a lot of BTC selling on-chain during that period. Remember the 8 billion Galaxy seller was like July, something in here. Then we had 1010, deleveraging event. So we never really saw realistically net buying outside of selling elsewhere. And now we've got just a hot nothing on flows on the 30-day cumulative. I was actually surprised looking at the cost basis, the MVRV for the ETFs. I was surprised we were still above that. I would think we would be lower than that by now, but I guess if it's 82.5, maybe that's an important level to watch. Now, last time we got around the cost basis of the ETFs, we sort of held steady. It was messy. It wasn't perfect, but we did survive. Now, that was pre-election. That was a different spot in the cycle. That was at the end of a multi-month consolidation, but just an interesting level to watch. If we can fight off 82.6, I don't want to sound optimistic because I'm not, but maybe an interesting level to think about going forward. And if we look at BTC today, what's changed? Nothing. I mean, still below the 200, still below the cloud. Things to watch for. Bearish TK cross price below cloud is not a bullish signal. A bullish signal would be a close inside of the cloud with a potential move, maybe even Q2. The dream would be holding above 82.6, turning this into whatever mess it ends up being, and then just taking the vanilla edge-to-edge trade from 92 to 103. At this point, it gets a little bit better on the risk reward because the cloud has come down a little bit. And you're probably going to get the 200-day moving average at the cloud if this trade triggers. So that's a perfect mean reversion to the 200-day. But here at the moment, I see nothing and have nothing on the BTC side. As far as the calendar this week, we have Consumer Confidence Tuesday. FOMC Wednesday is going to be a big one in that everyone's going to be watching it. It's probably going to be a nothing burger. Powell's probably going to shy away from anything Fed independence related. He's probably going to make a statement and then refuse to answer any questions regarding that. Friday, we've got PPI, but overall, a light week. Week after this week is unemployment ADP, so another jobs week coming up in the first month of February. No cuts expected here, with the Fed's rationale and the market's rationale likely being the jobs market is still too strong to justify a cut, despite inflation just falling off a cliff on the trueflation side. This is a multi-year low on inflation as measured by trueflation, and it's certainly getting there on the Fed's own estimates, 2.35. PCE still coming down month over month, and core is coming down month over month. And it certainly helps that gas prices are still very low, multi-year lows, right? We'll see how long this can hold, but this is also helping the inflation picture. And what's also interesting is you've got GDP estimates at 5.4%. So we are running it hot. Inflation's low. Unemployment is maybe deceptively low. I see a lot of statistics about how it's hard to get a job, it's hard to find a job, but it doesn't look like the Fed, at least Powell's Fed, will be cutting anytime soon, until he's gone, basically. The market is saying we don't expect a cut until Powell is gone. And whether that's Rick Rieder or Hassett or Warsh Walsh, whatever it ends up being. Quick check on RRP. RRP is effectively zeroed out. There is nothing left. There is fumes here below $1 billion now. I think it was that for the first time in many years. I'd have to zoom way in on this. What was it over here? 0.83. Okay. So we are very low on RRP. This is just excess capital outside of the system. Here's 10-2 curve. It's up quite a bit. Typically, we've seen recessions when the 10-2 curve spikes and GDP's crazy positive, so that's not going to happen anytime soon, at least as measured by the NBER, and unemployment is also not spiking yet. It is not curling up. It is not threatening to move up, at least how they measure it. So here we sit with just nothing going on the rate side. At some point, one would think, I don't think this is a trade today, but at some point, TLT may trigger a long side trade on the weekly. This is a really since COVID, this thing has drawn down. I don't know why or how, maybe yield curve control. The big issue with the long end is issuance, right? We cannot control our debt spending and it continues to spiral out of control. So it's hard to think why this would do well ever, but it's there. It's a thing in the background that is certainly setting up. Not quite ready yet on the weekly, and I really wouldn't seriously take this until 92 to 95. So it's got a long ways to go. But when it starts to turn the corner for whatever reason, I expect this thing to just go, certainly. HYG, which is high yield junk type stuff, looks very, very good. Tends to match the S&P's volatility, not volatility profile, but risk profile. So as goes HYG, so goes the S&P, vice versa. This looks like it wants higher. S&P looks like it wants higher. Qs look like they're fighting off bearishness and wants higher. All these things should be good for BTC. So we'll see, right? We can say there are all these market dynamics on technicals or things just pushing all-time highs, metals, pick one. Pick one of 10 things that are happening right now that should help BTC and just aren't. Here's another one. Dollar just continues to make multi-month lows on the Bloomberg index for the dollar. It's a multi-year low. So this continues to look weak and kind of mirrors the BTC chart, honestly. But you've got a high time frame bearish TK cross coming up here on DXY, and that is as bearish as it gets. But you still have, just like BTC, right, this move from 99 to 103 potential in the cards. One would think, as DXY starts to break down, BTC would start to look better and break up. But right now, everyone's super fixated on gold and silver. On the equity side, on S&P, doesn't look bearish. It's held above the cloud. Fought off any potential drawdown here. Fought off any move below the cloud. Continues to look fine, adequate. Does it look amazing? No. Are there better places to throw your money? I think so. But this looks totally fine. No issues whatsoever. And even the Qs, right? They're slowly but surely just batting off bearishness. Slowly. You have this huge topping pattern that looks like it wants to negate itself. And if this breaks 630, you'd think it'd be off to the races. This is a multi-month consolidation here that certainly looks like it wants to go higher. The Mag 7 ETF also has survived, despite Mag 7 as a group. We'll just go to that. Mag 7 as a group, to me, look soft. Google, certainly the leader. Meta bouncing. Microsoft bouncing, but still trend weak. Netflix, horrible. Amazon treading water, flat, neutral. Nvidia also has that head and shoulders risk, but just like the Qs, it looks like it wants to fight it off. Tesla treading water. Apple sort of bouncing. So to me, this looks like a giant mixed bag, but based on the ETF, it has bounced. And I think this is equal weight mags. I think it's all like 20% or something like that weighted. So if the highest market cap companies in the history of the world bounce, the indices are going to do well. They're going to bounce. So far so good on that front. SMH, I don't think there's a trade here at all, but also what is there to complain about, right? Nothing. This looks great. Looks fine. Plenty bullish. I haven't really looked at the sectors broadly, so I thought I'd do that for this video. One way to do that is to look at all the XL ETFs. You'll see them all here: XLE, XLU, XLY, XLK, XLP, etc. Just to look at sectors and then maybe drill down further on, for instance, XLE. There's CVX, which I opened today. Chevron looks very, very good. This is the energy sector. Looks great. Looks ready for all-time highs. Looks ready for more. No complaints whatsoever. Doesn't look anything like crypto. XLF looks Weak soft, this is financials, banks pulling back. Really nothing to do here, in my opinion. XLK Tech, basically the Qs, basically Mag 7 type ETF, trying to fight off that head and shoulders potential, trying to triangle higher. And any higher highs, it should be good to go. But no complaints there on the bearish side. XLP, this is consumer staples. Yet an inverted head and shoulders breaking up today above the cloud after a failed consolidation here. This also looks good on high time frames. So again, there's places to go. XLV, this is healthcare. This looks late from a trend perspective, but there are places to go that aren't Mag 7, that aren't the Qs, that aren't the SPY, even that aren't RWM. Just individually, these sectors have started to look really, really good. This is XLI Industrials, I guess closer to the Dow. To me, looks a little late on trend. Nothing really to do there. Materials, XLB, also a little late on trend, doing very, very well. And there's really nothing here that's like screaming bearishness. So I think that's another takeaway. Sector-wise, collectively, these sectors are doing fine. So what is there to be bearish about? Yet, nothing. Even XLU, utilities, super hot in 2025 on the AI data center stuff. This sort of looks like an inverted head and shoulders diamond bottom. And it kind of looks like falling wedge, all those BABA charts and the IRAN charts that have played higher. Definitely something to watch. It's more defensive historically, but it's a trade. It's something to do. So if this can push higher, why not? Right? We certainly need more utility type things in the United States. And here's XLY, consumer discretionary, another one that I wasn't really sure what was in this. And it makes sense that Amazon and Tesla are 43% of the weighting, and they effectively, this chart looks like Amazon and Tesla in that it's just sort of treading water, flat, neutral, but it does have this inverted head and shoulders characteristic to it, certainly. So even this looks fine, right? What is there to complain about? It is pre-breakout. It has consolidated since September, and it looks like it wants to go higher, just like Tesla and Amazon. Real estate, I would stay away from this one. This one just treading water. Really nothing at all to do here, probably until rates come way, way lower. So collectively, the sectors, what is there to be bearish? Nothing. These have consolidated and pulled up. Maybe financials looks the most bearish, but overall, things look fine. Things look absolutely fine. Individually, here, some names. DocN has started to break up a little bit more. That's one that people have talked about for weeks and weeks and weeks, and it's in the live portfolio of mine. Looks good. Plenty of room to run. Maybe it's a little late, but if you're looking for stuff to do on the momentum side, something to think about is anything that looks like this, because it had a multi-year consolidation. Today, Zoom had some news on some AI investments with Anthropic, blah, blah, blah. Again, I've said this for weeks, for probably months. It doesn't really matter what the news is as long as it's remotely positive, catalyst-wise. Because this has consolidated so long, it really helps push this out of the doing nothing territory and into, people start buying and there's momentum all of a sudden territory. So we'll see if we get any continuation off this on high time frames, but it is a multi-year high for Zoom. Stitch Fix is another one that I still like this consolidation. I still like this pattern. Doesn't matter what the news is. Any type of news whatsoever that's remotely positive should send this higher. I'm personally being very patient with this. And I still like ads here. I still like ads on Zoom. Again, if you're looking for stuff to do, there's plenty of things. Rivian, unfortunately, has just pulled straight back since those highs. Not looking great. I'm still holding it for the moment, probably foolishly. But I have hope that this will find a bottom, maybe soon-ish. We'll see. So that's all I got for this one. Give me a like, dislike, comment, share, subscribe, and happy trading.